my thinking of and why I'm net longer term bearish is that I do see us going into a recession, even if they start kind of coming down on the hikes less and less. We're still headed into a full-fledged recession. And again, I think once the market realizes the Fed can't bail us out of this recession, the market's going to freak out. It's going to say, okay, this could be a long, drawn out recession, making up for all the lack of recessions that we've seen over the past 10 plus years. And that could be this kind of stagflationary kind of period in the markets. And I think that's the culprit for the next big leg down that takes us down to the pre-COVID low highs from 2020 and even below.
Hello and welcome to Wealthy Value. In today's video, CEO and President of IntoMoneyStocks.com Gareth Soloway updates about the impact of current market uncertainty on the global economy, chances of a Bitcoin breakout in September 2022, and his thoughts on money printing, inflation, Fed policies, and recession. Make sure to stick around till the end of this video where Gareth Soloway reveals the possibility of an all-out panic in the markets. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
I think overall it's a negative, right? Anytime you have this potential geopolitical scenario, especially after Russia invaded Ukraine, it just opens a possibility that it could happen with Taiwan. It definitely puts people on the back burner. Now, the key is this market has been going up and down inversely to the US dollar. And we know that the more geo instability, the more upside on the dollar, right? More people hide in the US dollar for safety. And so that, again, just right there is a negative for equity markets, for crypto markets, for gold. Nicely enough, we have potentially seen a major reversal in the dollar today. So we might be seeing a short-term top there, which would be positive for risk assets. I think it does to some extent. Yeah, I do think, Tom, it does, because what you're seeing is essentially the Fed is trying to lead this push, and they're talking so aggressively hawkish. Now, I believe it's a lot of talk. I'm curious, once we tick into recession, how quickly they back off from this hawkish talk. But I think they're trying to talk a tough game to make sure that inflation kind of stalls out here and does come in. But I do think raising rates sucks money out of the system, right? So just like printing and lowering rates drives money into the system, it makes money free or at least cheap. The opposite is occurring. So it's a supply-demand economics problem where when you take dollars out of the system, inevitably the dollar should strengthen. And especially since we're acting more aggressively than the ECB or the Japanese central bank, it's going to strengthen the dollar against those currencies.
Mm-hmm.
Now,
I'd like to...
Sorry, I was just going to say something. If I could just show a chart here for you guys, because I actually think that, we just talked about, I just mentioned Japan, and I actually have a chart that dictates that I think we have a short-term high on the US dollar yen chart, and I think it's really helpful to take a look at. So let's take a look at this. Take a look at this channel. So this, again, beautiful trend line from this high going back to 2022, early 2022 here, and look at the yen, what it just did today, and how it's reversing. So these are the things that as a technician, I kind of watch for. And this, by the way, this doesn't mean that the yen is all of a sudden going to be strong and just continue to rally against the dollar. But what it tells me is in the short term, the dollar may be topping out and due for a pullback. So again, if you're looking over the next couple of weeks, I would expect further dollar weakness. And then this chart should come in and pull back, maybe down to this lower level. We'll have to watch and see. But those are just some cool stuff I love looking at. Bitcoin really, so one of the first things to note here is that Bitcoin for the last 10 days prior to yesterday was basically trading sideways, and that was while the dollar was going up, which is very unusual. But the dollar spiking yesterday in the overnight last night, it was finally kind of the straw that broke the camel's back. And finally, it broke that 19.5 level, which is the 2017 high. So if I zoom out here, you can see that's this previous cycle high back in 2017. So once that happened, there were a bunch of stops that got run, and it kind of pushed Bitcoin even lower. Today, we're seeing the dollar pull back, so it's bouncing, but it's a tough scenario for Bitcoin here, and I do think it's going to ultimately go lower. Doesn't mean if the dollar pulls back a little bit more, it won't have a small bounce, but I'm hard-pressed to find a scenario where Bitcoin doesn't at least go to 12 to 13,000 before putting in a bottom, and I have a worst-case scenario that's well below 10,000 on Bitcoin. So I think it's important for Bitcoin investors to realize that this is the first bear cycle that the Fed is not printing money during, right? And so you have to take that into account when you're doing your cycle. So if previous cycles saw an 80 to 85% correction, you got to think this one would at least do 80 to 85%, which would be 12, 13,000. And it might even do more. Yeah, so the euro chart is an interesting one. And again, it's a little bit on the harder side to figure out in terms of the highs. I'm looking at this relatively fresh, but this would be something that I would pay attention to. You have this angle where you were chopping along this trend line here, and it looks like we're kissing the low end of that after a very big move to the downside. You can see we had small bounces on the euro here, but for the most part, versus the dollar, the dollar's just been dominating the euro. And again, what's interesting here is this down move is coinciding with this potential bounce in the euro against the dollar is potentially coinciding with natural gas prices starting to fall. This is another really interesting thing. We know that Russia shut off that pipeline to Europe. Everyone was panicking over the weekend. And then what you saw is natural gas started to fall even in spite of that news. And one of the things I look at, and we can go to the natural gas chart here, one of the things I follow very closely as a trader is that when you have bullish news and an asset falls, or if you have bearish news and an asset rises, that does get my attention. It's telling you something as inner workings is going against the common kind of thought process. And so look at the fall in natural gas just over the last, let's say, 3 or 4 trading days. That's a big fall. And it tells me that the euro, if this pressure from Russia maybe doesn't turn out to be as crazy, as bad as everyone's talking about, maybe that's the reasoning why we're seeing natural gas fall and could be the culprit for a euro bounce against the dollar. It's a weird time right now because you're coming off of the COVID lockdowns and stuff like that. And then obviously there was the surge and then kind of the reflex retraction there. So I think it's one of the most hard times to really figure out what is a recession, what isn't. For me, what I'm going to look at is I'm going to look at the jobs numbers. You start to see a significant uptick in unemployment. We did see a tiny uptick in unemployment last Friday, but it was mostly due to people coming back to the workforce. I think that over the next few months, you're going to see that unemployment rise to 4%, a little bit above. And then once we see the GDP numbers remain weak plus that, then it's like, okay, this is a no-brainer official recession that you could call it that at that point. I mean, I have it penciled in for a 50 basis point at the end of September hike. So again, for me, now there's a lot of talk and the markets are even saying it could be 75 basis points. I'm thinking the Fed is, at least I hope they're smart enough to understand that they can't, and it's very dangerous to continue aggressively hiking rates because again, each rate hike takes a certain amount of time to work its way through the economy, right? So if you hike 3 times in a row, 75 basis points, and then all of a sudden in 6 months, we're in a deep recession, ask yourself, how do we get out of that recession? Because every past recession, the Fed has come to the market's rescue. QE, QE1, QE2, QE2. And I mean, you just went on and on all the way through COVID with printing money and lowering rates. And so the Fed can't do that anymore with inflation as high as it is. So I really hope they're careful. I think that they're starting to see those signs of weakness creeping in like they want, the inflation numbers coming down. And I think that that would be the goal here, to start that. They can always do 50 again later in the year if they want to, but starting to just bring it down a notch would be a very confidence boosting thing for the economy and for the markets. I think into year end or early 2023, your downside target on the spiders, for instance, you're looking at that pre-COVID high. So this is kind of my target. You're looking at like 338-ish or so. But I do think before all is said and done, meaning that whether it's 2023 or 2024, this market will go below there and go quite a bit lower. And I would not be surprised if we find ourselves retesting something down in this range quite a bit lower. Like you could be looking and saying, hey, markets are net down from their all-time highs, well over 50% from the highs put in when stimulus was at its max, when the government was sending checks and when money was essentially free. So I think there's a reckoning here that's going to come to the markets. And again, as long as inflation stays above 2%, ask yourself, how does the economy get itself out of recession once it gets in? And what if it gets bad? And that's going to be a real kicker, right? If we get into a bad recession, unemployment starts spiking to 5, 6, 7%, but inflation is still 4%, let's say. What ends up happening then? How do we handle it as an economy? And I think that's going to be all out panic in the markets when that happens. I think, for instance, Apple short term may be due for a bounce, but overall, that stock trading at a mid-20s PE ratio. I mean, in the olden days, and we're talking 10 years ago, 15, 20. I mean, if you go back pre-stimulus and pre-quantitative easing, a company like Apple was trading at a 10 valuation. And I do think that if you get in a scenario where money isn't free anymore and the Fed's not printing, we could see a reversion to that mean of valuations, which potentially, I mean, if you see Apple go down to sub $100 stock, think about where the NASDAQ 100 is at that point. So definitely something I paid attention to, because I think it's like that first showcase that governments are going to be very aware of economic hardships. And so, everyone says that the Fed can't print. And I've even said that to you, that it's going to be tough for the Fed to print when inflation is still elevated. But I do think that there is a point. I mean, there will be a tipping of the scale where if things get bad enough, even if inflation's at 4%, the Federal Reserve will start to print again. I mean, imagine inflation's at 4%, but unemployment's at 15%, right? You can't tell me that the Fed's not going to try to stimulate, that the government and the politicians that are trying to get reelected are not going to try to stimulate. They will absolutely. So there's this point where things will get so bad, they will start to print again. And that's where gold becomes key. I mean, so many of these metals and inflationary things, like even Bitcoin at a certain point becomes a no-brainer. And I think South Korea was just kind of that shot across the bow. It wasn't any major intervention. It just shows the willingness for governments to step in when things get rough. So I fully expect inflation to come down. I just don't think it's going back to 2% in the next many, many years. But do I expect 4% in a year, somewhere in that vicinity? Absolutely. I mean, there's no way oil can go from $120, $130 a barrel down to 82 where it's trading now, and you don't see some coming in of inflation pressure. So I think that's the key. We've seen a lot of metals like copper's collapse from its highs, nickel's collapse from its highs. That's all come back in, which will help alleviate the inflation pressures. The one kicker of why I think inflation will remain above 2% is because you have the inflation on wages, right? And so basically companies have had to pay workers quite a bit more, whether they were paying $15 an hour, then they had to go to $25 an hour, whatever it may be. But what they can't do, McDonald's can't double the price of a burger overnight, right? So what they do is they'll raise it by 10%, like the dollar store raised their prices from $1 to $1.25, right? Now they're paying their employees double probably, but at the same time, they couldn't do that. They can't raise it from $1 to $2. So what they'll do is over the coming years, they'll slowly inch those prices up to compensate, and that'll keep inflation above 2% over the next few years.
So, do you think the markets are due for another major blow? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.